Welcome back to the Digital Asset Report. Bitcoin is trading near 63,000 after one of the most volatile stretches of the year. It briefly broke below 60,000 last week, then bounced as crypto recovered. But the pressure is still clear. US spot Bitcoin ETFs just ended a 13-day outflow streak that pulled roughly $4.4 billion from the products, and total Bitcoin ETF holdings are now down more than 7% from their peak. The bigger story this week is stablecoin infrastructure, payment processors, wallets, custody systems, compliance tools, and settlement networks. Stablecoins are moving from a crypto trading tool into a financial utility for cross-border payments, treasury operations, and round-the-clock settlement. That shift is forcing banks to respond. JPMorgan, Bank of America, Citi, Wells Fargo, and other major banks are planning a shared tokenized deposit network through the Clearinghouse, the oldest banking association and payments operator in the US. With a target launch in the first half of 2027, the goal is to give bank deposits stablecoin-like speed while keeping the money inside the regulated banking system. Here's Congressman French Hill speaking on the Clearinghouse.
The bill will be good for the banks. JPMorgan, Citi, Bank of America, and Wells Fargo, all the banks reportedly planning a new tokenized deposit system of their own to address crypto concerns. How do you see this?
Yeah, I've watched this over the last few months, Maria, of Brian Armstrong versus editorial comments from the big banks.
Yeah.
And I have to say thank you to Tim Scott and John Bozeman and the other senators that have worked to try to find a landing spot on this debate. Senators Tillis and Alsobrooks have worked greatly. In the House, we said that stablecoins would not pay interest, and that's still my position. It's a payment token, and I think the sales practices around a non-bank or bank issuer of a stablecoin should be handled in the regulatory process to implement Genius by the Treasury Department. This statutory language, which Tim Scott found a good compromise for in the Clarity markup, is a good starting spot that I think you can find consensus from by both the banks and the crypto exchanges, and I hope they do, because we need this bill. We need market structure, and I believe the banks, as you just noted, will be extremely competitive in this industry. I just don't have any doubt about that because of the technology to tokenize deposits allows one to not even depend on a dollar-backed stablecoin here in a U.S. type application.
And the banks talked about tokenizing just this week, and they are launching this network that will launch next year, operated under a company called the Clearinghouse. It allows tokenized deposits to move immediately across blockchain technology with 24/7 settlements.
This is a major structural moment. Stablecoins create a competitive threat. Now, the largest banks in the country are building their own blockchain-based settlement rails. They're not standing outside the digital asset market anymore. They're trying to define the version of it that fits inside traditional finance. In Washington, that same fight is slowing the policy process. JPMorgan warned this week that the window for passing the Clarity Act may be narrowing as the midterm calendar approaches. The key dispute is still stablecoin yield. Banks want limits because they fear deposit flight. Crypto firms want flexibility because rewards is part of how they compete. CME Group CEO Terry Duffy is warning that newly approved crypto perpetual futures could create systemic risk. Kalshi is preparing to launch the products for U.S. investors through regulated venues, opening the door to high-leverage instruments that used to live mostly offshore. That's a major shift for U.S. crypto derivatives, but it also raises real concerns around retail leverage and automatic liquidations. And prediction markets are facing their own trust test right now. Polymarket finalized a disputed market asking whether Strategy sold any Bitcoin by May 31st with a no outcome, even though Strategy later disclosed that it sold 32 Bitcoin between May 26th and May 31st. The traders on the yes side argued the event happened before the deadline. The no side argued the sale was not publicly confirmed until June 1st. UMA's final review backed the no result, with 98.6% of voting power, turning the dispute into a bigger question: should prediction markets resolve based on when something happened or when the public can verify it? Finally, there's a security warning from Zcash. An AI model helped uncover a 4-year-old flaw that could have allowed unlimited counterfeit tokens if it had had not been fixed. Zcash says the issue has been remediated, but the episode shook confidence and raised a broader concern. Zcash traded down 60% on the news, but has largely recovered as of Monday. As AI gets better at finding hidden bugs, crypto networks and even bank software may need much stronger formal verification. Put it together, and the week has a clear message: price is fragile, ETF flows are a headwind, and speculative markets are being tested. The infrastructure story is moving fast. Stablecoins are becoming payment rails, banks are building tokenized deposits, derivatives are coming onshore, and prediction markets are facing questions on outcome resolutions. Our markets may be under pressure, but the future is still being built. That's it for today. If you enjoyed this video, be sure to give us a like and follow along for more.